Hello, I'm Bridie Barry. Welcome to Market Moves. Our guest today, Roger Montgomery, independent investment expert from rogermontgomery.com, joins us to tell us what moved the markets. Roger, good to see you. Thank you so much for coming in.
Thanks for having me on,
It was quite
Bridie.
a sell-off, wasn't it, today? I mean, do you think it was a little overdone?
Look, unlike many of your other guests, I don't have a view over what happens. I don't really know, unless you and I go and talk to every person that bought some shares and sold some shares and find out why they did it. We won't ever know why the market went up or down today. What I do know is the market seems to be a little bit expensive, and what that means is that it's above its intrinsic value at the moment. So my view is that there's bias to the downside, but I can't predict where the market's going to go. What I do know is the value's a little bit lower than where the market is today. It's a good couple of 100 points down from where it is, and so that would suggest to me that. And when I look at individual, I should add, when I look at individual companies, I don't find a lot of good value, and that tells me the market is a little bit expensive. Now, it doesn't mean it's going to go down. It could mean that it goes sideways for a while and the value catches up. That's entirely possible. But we'll have to wait for the full year results to actually see whether or not value has caught up.
So because that's something that certainly RBS traders were telling Dow Jones Newswires today, that they see something similar, a drift, perhaps a little fall until we get a catalyst like those August earnings seasons.
I have to admit, I'm not as precise as the guys at RBS. You know, I can't get it that right. I'm not that smart. But what I do know is that in order for the value to catch up, we're going to have to see some pretty big surprises on the earnings side. If that happens and return on equity for a lot of big companies jumps, then what we'll actually find is we'll find intrinsic value rising. It'll catch up and the market will go again. Generally speaking, my observation is historically the Australian market tends to trade a little bit higher than intrinsic value, and that's because we've got about 3,000 funds trading 2,000 odd stocks. We have a dearth of really good quality companies in Australia, and we just don't have many of them, so that means they tend to trade a little bit of a premium to intrinsic value. So I'm not so concerned about one day's price action. I'd be very interested in buying the market if it fell 400 or 500 points. You know, I think there'll be some interesting opportunities at that point.
Just as well, I mean, the overall outlook too, we've seen the IMF, you know, pretty rosy outlook for Australia. Some saying it's not even rosy enough.
Sure.
Just generally, I mean, are you confident in the economic recovery here in Australia, or could you see pockets of weakness?
Do you know, I had a meeting today. I was in Pyrmont and Glebe and had a couple of meetings, and I noticed just how buoyant people seem to be. You know, just anecdotally, people seem to be very confident. But really, our success is confined to the resources sector, and the resource sector's success will be largely dependent on how China goes. I think Australia is going very well. I think we're very fortunate because of our geographical location, because of the wealth that's in our soil. You know, it's a cliche, but it's true. What worries me is that things don't go up in a straight line. China won't go up in a straight line. When I look at the analysts' expectations across all the resource stocks, they're a hockey stick, a very steep hockey stick, and everyone thinks coal's going to go up forever. And look, it may go higher, but it won't go up in a straight line. And China won't expand in a straight line. It'll hit speed humps along the way, and there's a property bubble there without any shadow of a doubt, and how China handles that will have a big impact on us.
And another loser, as we saw there earlier, Wesfarmers. It's seen an improvement in retail revenues in the third quarter, but it signalled some caution about the current period, given the fiscal stimulus spending that boosted last year's figures. Sales at Coles were up nearly 5% to just over $6.9 billion. Kmart showed a 4% improvement. Overall, were you happy or disappointed with what Wesfarmers had to say today?
This is I think most of your viewers know my view about Wesfarmers. There's been a lot of enthusiasm for the company because of the turnaround in Coles, particularly in Kmart. And so what's actually happened is there's been a mass exodus from Woolworths into Wesfarmers. Now, Woolworths is the better quality business, there's no doubt about that. A much higher return on equity, stable over a long period of time, and they really have the runs on the board. They've proven that they're successful. You know, they've got a really good demonstrated track record of earnings power. Coles and Wesfarmers, or Coles rather, doesn't. And while it's turning around, the return on equity of Coles is appalling. You know, it's a terrible rate. You know, we're talking single digits, lower than what you can get in a bank account. So if I gave you the opportunity to put $4 billion into a bank, you'd get 8%. You know, if I offered you the $4 billion to put into Wesfarmers, you get a lower rate than that. Plus you've got execution risk. Plus you've got the risk of the stock falling. Plus you've got all the risk associated with running a business, and you're getting a lower rate of return. Now this is going to knock your socks off, but the value, the intrinsic value of Wesfarmers is close to $13 right now. And next year I've got it going to $17.75, and then the year after $20.57. But the share price now is well over $30. So the intrinsic value of this company is currently less than half of its share price. That tells me this is, as a value investor, as someone who looks for low-risk opportunities by buying great businesses when they're cheap, this doesn't meet the criteria at the moment.
Okay. All right. Plenty more to ask you about, Roger. Another story today. Another stock that fell too. There are quite a few of them today. Caltex. Looking at Caltex, then it says that the mid-term outlook isn't too bad. Are you cautious on this stock then? What's your valuation of Caltex?
Yeah. The company's share price, it's had an enormous drop when you go back to sort of 2007, around 2007, I think it was. Its share price was significantly higher than where it is now, more than double where it is today. And the intrinsic value has done the same thing as the share price. It's been dropping over time. That's generally not a good sign. You don't want to invest in businesses whose value is going down. There's a terrific quote from a guy named Benjamin Graham, who was Warren Buffett's mentor. He said, in the short run, the market's a popularity. He said it's a voting machine, but in the long run, it's a weighing machine. In other words, in the long run, price tends to follow value. And the value for this business is pretty much going nowhere for the next couple of years. And in fact, I've got a valuation on it of $7.01. And rising to $7.58 by 2012, and that's lower than where the current share price is, of course.
Right, okay. Plenty more production reports and updates as well coming from a couple of other companies. Well, certainly Santos as well, oil and gas producer in that same sector. It reported drops in both output and revenues for the first 3 months of the year. As a result, it's had to lower its full-year production guidance by 2 million barrels of oil equivalent. Shares today were down 1.7% to $13.96. Looking at Santos then, Roger, where does that sit in your valuation?
Well, I've been on the program here previously and talked about Santos. My preference out of Woodside Petroleum and Santos is going to be Woodside. Santos' share price is, of course, nowhere near. You can see there, you've got a share price of close to $14, and I'm embarrassed to say that the intrinsic value of this company is closer to $5 than it is to 14. Now, why is that the case? I don't know. Some companies simply trade with no relevance to the intrinsic value, but this company has previously had an intrinsic value of $2.46. It's gone as high as $18, and now it's dropped back down to sort of $5. It's a very volatile company in terms of the change in the intrinsic value, and that's because it's in a space that's volatile. It's a commodity business. Selling commodities, you're a price taker, and you really have to be able to predict the commodity price to know what these things are going to be worth in the future. That's really hard to do.
Okay, all right. From the black gold there to the yellow metal, Newcrest Mining today posting a drop in third quarter gold production and has downgraded its full year guidance. Just looking at Newcrest then, what do you think of this stock? Well,
it's interesting. It's terrific to look at these sorts of businesses, because what I can tell you is that the return on equity of this business has ranged in the last 15 years, has gone from negative 10% to positive 21%, and it's now about 7%. So if I said to you, look, I've got a bank account and it's got $10 million in it and it's earning 7%, well, that's kind of the rate you can get in a bank account at the moment. So if I said, what would you pay for that bank account, you'd say, well, I'd pay the $10 million for it because it's giving me 7%. If a company's share price is trading above the intrinsic value, then what I'm saying to you is that the share price is, that you're buying the bank account for $20 million, even though there's only $10 million earning 7%. And that's the case for Newcrest. Newcrest is actually worth close to about $15, and its share price is significantly higher than that.